Welcome to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank that brings you market views and insights on the go.
Hello everyone, my name is Manpreet and welcome to Cut to the Chase, a podcast where we help you focus on market events that we believe truly matter. Now, while equity and bond markets across Asia, Europe and the US largely extended their recent moves, firmly pushing the Nasdaq into a 10% correction from its recent peak, there has been a lot of focus on oil as well. WTI oil prices are up about 12% since the start of the year and almost 30% since the early December low. This has meant the $100 barrel forecasts are back in the broader narrative. Now today there seem to be two factors potentially explaining the price rise. One is more event-driven, citing what we've seen in the last couple of days in terms of the Iraq-Turkey pipeline disruption and attack on oil facilities in the UAE. The other, of course, looks at the longer-term tight supply-demand balance. Now, we'd worry less about the first rationale. We remain of the view that the impact of geopolitical events on markets generally tends to be quite short-lived, unless it alters the long-term demand-supply balance significantly. If you follow me on LinkedIn, take a look at a short article I wrote on why we do hold this view. The second factor, though, the long-term supply-demand balance, we think better explains what's going on with oil prices. Demand has actually held up pretty well despite Omicron, and OPEC Plus has continued to raise output at its pre-planned rate of only 400,000 barrels per day each meeting. We've also seen a number of unplanned production outages in recent days in several countries like Libya and Kazakhstan. Now, some of these factors, of course, may be set to change later in the year. We've seen a couple of OPEC members come out in recent days arguing that prices above $85 per barrel could trigger demand destruction. And the IEA also said overnight that accelerating output from OPEC Plus as well as the US and Canada means supply could also rise significantly later this year. Now, all of this fits in with our own view that while upward pressure on oil prices could remain in place in the first few months of 2022, these price pressures could soften somewhat in the second half of the year as supply growth extends and demand growth eases somewhat as economic growth settles down closer to its long-term trend. So that's on oil, but the other key event today, of course, is the ECB policy meeting. Now, it's interesting that similar to what we've seen in the US, markets seem to be pricing in a couple of 10 basis point rate hikes in 2022. And this has helped the 10-year German government bond yield, or the German Bund, nose just above 0% after years of negative yields. However, we do expect the ECB to signal its comfort with existing policy, and FX markets, this could offer the US dollar a little bit of a reprieve. And finally, in China, there are news reports that policymakers are considering making it easier for property developers to access funds from pre-sales that currently are required to be held in escrow accounts. Now, this is significant because it could potentially unlock liquidity for developers at a time when it is most needed. The Hang Seng's Mainland Properties Index did rise following the report, but what we'd also look for is signs of potentially more improved sentiment in Asian high-yield bonds later today. So that's it in terms of key events. Before I leave, just a reminder that Steve is back tomorrow with his Through the Noise podcast, so please do watch out for that. If you enjoyed this podcast, please don't forget to rate and like it. Thanks for listening and wish you a happy trading day ahead.
Thank you for listening to Standard Chartered Money Insights, a podcast series by Standard Chartered Bank. For more details on the latest market insights, subscribe to Standard Chartered Money Insights.